Want to talk markets right now. Joining us is Dave Secchieri. He's the Chief U.S. Market Strategist at Morningstar. Lindsey, Chief Economist at Stifel. Good morning to both of you. Yesterday we had Richard Fisher on the broadcast. This was after we got the GDP number, and he said that he thought that we had a A-plus economy. A-plus was the grade he gave. At one point then he might have gone down to say it could be an A or an A-minus, but I'm curious if you think that's the case or not. Dave?
It might be an A-plus right now, but we do think that the economy is poised to weaken. We're looking for GDP to decline sequentially for the next 3 quarters, bottoming out in the third quarter before we begin a recovery thereafter. But I think really it's more all important about looking at inflation. We'll see where the number prints today. We are also looking for 0.2% increase on a month-over-month basis. But we do think inflation is going to continue to moderate. When we look at core PCE by April, we think it gets down to a 2.1% year-over-year run rate. We think that gives the Fed the room to be able to cut even as soon as here in March.
Do you still think that there's a chance that we get a cut in March? I think a lot of people saw yesterday's number and thought that's hotter than we thought. Maybe we're not going to see that. Lindsey?
I think with the economy right now, as solid as it is, I think the argument should be how long will the Fed remain at these elevated levels? The Fed has been willing to introduce potential rate cuts in the future into the conversation. But when you talk about an economy growing at an above 3% pace, the consumer up near 3%, investment at 2%, and inflation still stubbornly elevated, I think it's in many cases, historically, we would have been talking about further rate hikes as opposed to rate cuts. So I do think that right now, while the economy is losing momentum, some fatigue is setting in, we're still on very solid ground. And this justifies, at the very least, for the Fed to be on hold for much longer than the market's expecting, with that first rate cut pushed out not just to the second quarter, but likely to the second half of the year.
Okay, so if Dave's in March, and you're in, June, Lindsey?
I think it could even be later than June. I think depending on the evolution of the inflation, which could very easily reverse course mid-part of the year, the Fed could be on hold until September. But June is a very realistic timeline should we see further disinflation.
Before I go back to Dave, though, there is and I know it's maybe like a conspiratorial view, but I think it's maybe just a practical view, that perhaps once you get towards August or September, if you are the Fed, you almost feel like you can't do anything, given that you're 2.5 months out, 3 months out from the presidential election. Do you think that's true?
I think there's an unwritten message from the Fed that they would prefer not to tinker with rates as Election Day approaches. But historically, the Fed has been very willing to raise rates or cut rates during an election year with both an incumbent Republican and a Republican incumbent Democrat. So that certainly won't preclude them from adjusting policy if it's in the best interest of achieving their dual mandate of stable prices and full employment.
Dave, it sounds like you disagree vehemently, which makes for a great cable segment. Tell us why.
We're very confident that even if they don't cut in March, they will end up cutting, at the May meeting. And again, it all comes down to inflation, inflation moderating, even in face of the economy still being a little bit hotter than I think most people expected. You also have to remember, too, the Fed was pretty late when inflation was rising. So I think that the Fed's got to be very cognizant to the opposite side that, with the economy starting to weaken here, and they are trying to engineer this soft landing, I don't think they want to get behind the ball and not start cutting early enough. So I do think that they need to cut, and if they don't cut, then I think that's going to change our base case from the soft landing, into the recessionary territory.
You think a recession is still in the offing?
Well, that's not our base case. Our base case is that the Fed starts to cut, either here in March, and if not March, then in May, and that will then, be able to help the economy bottom out in the third quarter and start, rising again at the end of the year.
Hey, Lindsey, it said, I heard you in the eye of the beholder, maybe, but you said that the Fed's going to keep rates at these elevated levels. Compared to what? Elevated? I don't. Is that the right word? Are they elevated? Historically.
Well, they are elevated.
Or normal.
But remember,
or
most investors are remembering the pre-pandemic era of near zero interest rates, and that's part of the reason that the market is perpetually calling it an end to a preemptive end to rate hikes over these past few years, and pricing in rate cuts because this experiential bias, the normal of the pre-COVID era of easy money. But you're right. Historically,
we know zero wasn't right. We know zero was that's not. No one thinks that was normal. What's normal? These aren't elevated in terms of
well, they're not elevated on a historical
ranges.
basis, but again, relative to the era, the decade leading into COVID, they certainly are. And when you only remember zero interest rates, when you're talking about the Fed raising to 5 and holding rates at 5, that seems inconceivable if all you've known is that normal world of near zero interest rate policy prior to the COVID pandemic. So again, it is in the eye of the beholder, or we do have to put this relativity cloud over that. But I think that for the Fed's perspective, when you're looking at such a solid economy, when you have such a number of wild cards, including international factors outside of the Fed's purview, which could cause a reversal in inflation mid-year, there's no rush to remove this level of restriction in policy. We don't need to remain at these levels perpetually, but there is no rush. And I do think the market is overpricing in anticipation of the first rate cut and the pace of rate cuts. I think that will very much be tempered at 25 basis points a quarter, leaving us well beyond neutral as we look out to 2025.